Stan Druckenmiller says the dollar will lose global reserve currency status. I'm going to explain when he's saying this will happen and why in 3 simple, fast steps. Step number 1, let's go over the government spending, M2 money supply, and the debt of the government exploding over 2020 and 2021, and how this can lead to the dollar losing global reserve currency status. But before we get to that point, let's go to a clip from CNBC, an interview with Stan Druckenmiller, where he'll tell you how quickly he thinks the dollar will lose global reserve status. Editor, let's cut to the clip.
Let's talk about the dollar. And 85% of the transactions are still done in the dollar. You pointed out in a recent speech that you think we've crossed the Rubicon. Are you comfortable saying what you said there, that for the first time in your career, you think we lose reserve status at some point?
I'm comfortable with it. That's my central case. As you know, Joe, I can change my mind. But yeah, I think it's more likely than not within 15 years we lose reserve currency status.
So his prediction is within 15 years, by 2036, the United States will no longer have the exorbitant privilege. But let's go into the why. The first chart that Stan pulls up in the interview is retail sales going back to the GFC. We start 2007, go all the way to 2021 on the left, from 225 billion up to 675 billion. We know what happened during the GFC. Retail sales plummeted, fell off a cliff. And it actually took 6 years for us to get up to the same level we were in 2007 before everything collapsed. Compare that to what we see today. During the cerveza sickness, retail sales plummeted once again, but then because of the stimulus checks and extended and increased unemployment benefits, the retail sales rebounded. This time, it didn't take 6 years. It only took 6 months due to the amount of government spending. In other words, the amount of government debt that has increased the deficit spending. And because the Fed was monetizing that debt, we saw a 25% increase in M2 money supply. In other words, the amount of dollars in the real economy chasing goods and services. This is why you have noticed prices of everything you buy daily going up over the last year, 6 months, etc. But the next statistic that Stan points out is really mind-blowing. Since we got back up to that trend line, we have increased retail sales by 15%. Why is that such a staggering number? Because historically, retail sales average about 3% growth. But because your drunk, insolvent Uncle Sam is giving all those stimulus checks and additional unemployment benefits to Moody the millennial, everyone's favorite with their blue hair, Moody is going out and spending money like a drunken sailor. That money that they are getting from the government. That's why you're seeing such a massive increase in retail sales and consumer spending. But let's think this through. Stan points out that we average a 3% growth rate over time. But just in the last year, let's say, we've grown by 15%. So what that means is the government has brought 5 years of future demand into the present. And he didn't really outline this in the interview, but I would like to point out to you guys watching right now that if the government has created all this additional spending, businesses are now hiring and building their business and future projections around this level of sales continuing. So what happens if the government turns off the stimmy spigot? All this comes crashing down and those businesses go bust to an even greater extent than what we saw during the beginning of the cerveza sickness, where the government-induced lockdowns put hundreds of thousands of small and mid-sized businesses out of business right here in the United States. And let's remember that all this additional spending is a result of the government going further and further into debt. In 2020 alone, we are running almost $5 trillion deficits. And what Druckenmiller points out is this is being monetized by the Fed. And the reason that's important is because when the Fed monetizes the debt issued by the government, it increases the money supply, or the dollars chasing those goods and services. Let me explain how this works. Typically, the government comes in and they need to raise, let's say, $50 billion. So the Treasury has an auction. Those treasuries are sold into the real economy. So those dollars come out of the real economy, go into the government, their account at the Fed called the TGA, the Treasury General Account. But then your drunk, insolvent Uncle Sam spends that same money back into the economy to do what? Buy more votes. So when they spend that money, they're spending money that they already took out of the economy. Therefore, the amount of dollars decreases here, increases there. So on net balance, it's a wash. But what happens when the Fed monetizes the debt? In other words, when the Fed buys the debt from the government. In this case, the Treasury issues those bonds at auction. But instead of individuals in the real economy taking their money and giving it to the government, the Fed prints up bank reserves, funny money, and buys those treasuries through a shell game with the primary dealer banks. But basically, they're buying those treasuries directly from the government. So then those newly created bank reserves go into the TGA. So when your drunk, insolvent Uncle Sam spends the money out of their account, they're spending newly created dollars because they're not taking those dollars out of the system to begin with. This whole process of debt monetization is why we saw M2 money supply go parabolic in 2020 and why we will most likely see it continue to grow at breakneck speeds into the foreseeable future. So I know a lot of you watching this video right now are probably scratching your head and saying, okay, George, I get it, but if that debt monetization is such a big deal, why don't they just stop and start selling those treasuries back into the real economy so they're not increasing the amount of dollars by such an extreme rate? Because what would happen if the government sells those treasuries into the real economy, they would need a much higher interest rate because of inflation expectations. We see the 10-year treasury going straight up over the past few months. So if the interest rates that the market demanded, the people buying the bonds, the individuals and entities, if those rates went up, this would crush the economy even further because the debt in the real economy, in corporate America, and at the government level is at all-time highs. We cannot afford higher interest rates. So what this means is the Fed and the government have painted themselves into a corner where the government has to continue to deficit spend at almost exponential levels. The Fed has to monetize the debt. And Stan Druckenmiller's point is the only way out, the release valve, has got to be the value of the dollars you have in your bank account. Step number 2, the government's off-balance sheet, or BS, commitments. And if you think Druckenmiller gave a great argument for the value of the dollar plummeting in step number 1, you ain't seen nothing yet. So let's dive into these off-balance sheet commitments that the government will have in the future, but isn't even calculated in the $28 trillion that they have right now. At least that's what they're willing to admit to as far as on-balance sheet debt. One thing I want to point out, it's very important for you to get your head around, and this is something my good buddy Luke Gromen talks about all the time, is the off-balance sheet debt the government has is very tough, if not impossible, to reduce through inflation. You guys know from watching my videos that if we get significant rates of inflation in the United States, that most likely increases the tax receipts going to the government, and it reduces the debt to GDP ratio. That's one way, the hidden tax that Milton Friedman talks about. That's one way for the government to lower that without increasing productivity or actually the growth of the economy, the real growth. But let's think through this. So if the government owes things like Medicare and Medicaid, they're not saying, hey, baby boomers or retirees, we owe you a specific dollar amount every single month. You see, it's much different than Social Security, where they say, okay, we're giving you $2,000 a month. What they're saying is we are giving you or promising you these services at any price. So what this means is that if they get inflation to wipe out or reduce the debt to GDP burden, that isn't going to bail them out of this commitment because they've promised services, not a nominal dollar amount. So let's go through this chart. And this is something that I pulled up online. And it's a chart of the amount of Americans, or the number of Americans on Medicare and the projections moving forward. So it starts in 2000, goes to 2050. On the left, we go from 0 to 100 million Americans. In 2020, we have about 64.3 million people currently on Medicare. The projection for the next 10 years is for that to go up to 81.5 million, an increase of 17.2 million, or an increase of 26%. And we're actually going to use this number in a moment to calculate the increases down below using this pie chart. But let's focus on that. Let's look at the spending increases for a moment. And I want to point out that we're using a baseline of 4.1 trillion. We'll call it 4 trillion. This is what the government was spending in 2018. Keep in mind, since 2018, the debt has increased by, call it 7-8 trillion. I mean, who's counting anymore? But the expenditures of the government have gone from maybe 4 trillion in 2018 to, I would say, probably 8 or 9 trillion, maybe even more in 2020. And I believe that we're going to see those expenditures continue to increase into the future because the government has built the entire economy around stimulus. The economy is addicted to the monetary heroin, as my good buddy Peter Schiff always points out. And just like a heroin addict, we're going to have to give the economy more and more and more of that monetary heroin, the monetary drug, the stimulus that it requires just to receive the same effect. So let's dive into the numbers in greater detail. We've got this pie chart, and as you can tell right off the bat, I am very bad at drawing pie charts. So Editor, help me out with this one. You guys are going to have to use your imagination. But we start by pointing out that 24% of current outlays, again, this is 2018, was Social Security, 15% Medicare, 8% interest, and this is a biggie, 11% for Medicaid, and the wild card, which I want to point out down here, is discretionary spending. This was 15% back in 2018, but who knows what it is today with the government and their trillions of dollars of deficit spending, specifically discretionary spending. Now, let's specifically address the interest rate. We were paying about $320 billion back in 2018. It was about 8% of the total outlays. But Druckenmiller points out that this could go up to 30%. Editor, let's cut to the clip.
This is the CBO. This is not me. Okay, and they're saying if 10 years go to 4.9%, which is their normalized projection, the interest expense alone will be close to 30% of GDP every year. That's basically what we just spent on the COVID emergency in the last year. There is no way we can afford to have 30% of all government outlays be toward interest expense. So what will happen is the Fed will have to monetize that.
So if interest expenses go up to 30% of the budget or the outlays, and keep in mind, this is based on 2018, where they were spending $4 trillion. Now they're spending probably $8 trillion, $9 trillion, $10 trillion. Who knows what it's going to be this year? But just based on that 2018 numbers, that takes the expense from $320 billion all the way up to $1.2 trillion just for interest on the debt. And I hate to beat a dead horse, but I want to remind you one more time that this number is based on the debt being $20 trillion approximately. Now it's $28 trillion and growing like Buzz Lightyear to infinity and beyond.
To infinity and beyond.
And then based on this 26% increase, Medicare costs go from $600 billion to $756, Medicaid $440 billion to $554 billion, giving us a net increase of $1.15 trillion, which we know using today's number would be way higher than that, probably closer to an increase of $2 or $3 trillion. Oh, but wait, as you can guess, there is more. Going back to the wild card that I was referring to, this discretionary spending. And Druckenmiller doesn't really talk about it too much, but I think it's going to continue to increase, which creates further inflationary pressures, consumer price inflation. And what happens if consumer price inflation goes up or is expected to go up in the future? Most likely the yield curve, which we talk about in a lot of my videos, and I've got a small yield curve here. It's just basically telling us what interest rates are doing on treasuries. So, editor, I don't know if you can zoom in on this one. But if you guys can't see it, you have to take my word on it. On the left, we go from 1%, goes up to 4%. We go 3 months, 10-year, 30-year. But the whole point is if interest rates start to go up over time as a result of future inflation expectations, which is a result of the government spending more and more money on stimulus infinity, that's going to drive interest rates even higher than the 4.9% that Druckenmiller was referring to in the clip. And right about now, you may be saying to yourself, yeah, George, I get it, but I don't think that's ever going to happen. I don't think we have to worry about interest rates or the yield curve because the Fed is going to come in and peg the interest rates. They're not going to let them go up. And you may be correct, but let's think through what that means. If the Fed buys enough bonds to keep the interest rates low, meaning they're buying those bonds directly from the government when they're issuing them, that means they're monetizing the debt. If they are monetizing ever increasing amounts of debt, that means that M2 money supply is continuing to go parabolic. In other words, the amount of dollars that are in the real economy chasing those goods and services you buy on a daily basis is going to continue to increase at breakneck speeds. So if this all plays out like Druckenmiller is suggesting, the government and the Fed are going to have only one choice. That is to print mo money, and mo money. Editor, help me out with the clip.
More money, more money, more money.
Step number 3, the end game. In steps number 1 and 2, we talked about how the dollar has a lot of headwind, and what the government and the Fed is doing could lead to a dollar collapse, going down in value against goods and services here in the United States. And although this would prompt a lot of foreigners to want to hold fewer dollars, we haven't discussed the specifics on the dollar losing reserve currency status, according to Stan Druckenmiller. So let's dive into some charts. The first one I want to look at is U.S. current account. And this is where we can see the trade deficit or surplus. We start at 2015, go to 2020. On the left, we go from 0, is actually way up here this time. And because we're dealing with the trade, which for the United States is always a deficit, 0 is at the top. Then we go all the way down to a negative 200 billion. 2015, we're right around negative 100 billion. That goes down in 2018. And then during the cerveza sickness, the trade deficit increases massively, and it's continued to increase into 2021. Why is that? Because the government has been paying people like everyone's favorite Moody the Millennial to stay home and not go to work. Well, if Moody can't go to their job, because I don't know Moody's preferred pronouns. You see, I'm being politically correct. Wait till we get down here, and I'll go back to being politically incorrect. In fact, wildly politically incorrect. But more on that in a moment. But the government is paying Moody to not produce stuff. Well, Moody's getting a lot more money from the government to buy more stuff, which they are doing significantly. Going back to the chart of retail sales we looked at in step number 1. So if Moody is producing less stuff but buying more stuff, where are we getting the stuff? It's being produced by China, by Vietnam, by countries outside of the United States. We'll call it country XYZ. So they are producing all of the stuff that Moody is consuming, and then Moody is sending country XYZ all of their dollars. This is why the trade deficit increases significantly. But what it also means, which I've tried to point out with this kind of inverse trend line to mirror what we have with the trade deficit, is as the trade deficit increases, the amount of dollars going out of the United States into the global economy and circulating are increasing. Now let's move on to a chart of the capital account. Starts in 2018, goes to 2020. On the left, we have a negative 3, which indicates negative $3 trillion. We go up to 0 When we get to positive, then it goes up to $1 trillion. The capital account is a net balance of how many assets foreigners are buying in the United States compared to the amount of assets U.S. citizens or Americans are buying abroad. So when you see this number go lower, that means that foreigners are buying more U.S. assets. Assets like treasuries or equities. And Druckenmiller points out to CNBC that in his 40 years of managing money, and by the way, being one of the best money managers we have ever seen in history, he has never seen anything like what happened right here in 2020. To allow him to explain further, we'll cut right to the clip.
Last spring, in the midst of an equity market meltdown, and I've been trading for 40 years and I've never seen anything like this. Right in the middle of an equity market meltdown, the bond market went down 18 points one day. And everybody thought it was macro traders like me and others that were rejecting the implications of the CARES Act. The Fed did a deep dive, and by hindsight, foreigners sold $1 trillion of treasuries overnight as we were proposing the CARES Act. They've continued to sell treasuries ever since then. Why is that important? Because for 20 years, treasuries have been the go-to asset of foreigners to hedge global portfolios with. In every case, whenever you had a problem in the equity market or in the world economy, they fled to treasuries and they fled to the dollar. Last spring, that was violated. So since then, they've continued to sell treasuries. So what we've gone from is for 20 years, an average flow of $500 billion a year into treasuries from an outflow out of treasuries. So when you have a $700 billion current account deficit, our estimate for the year, you need capital to flow in to offset that. If you just erase 500 billion inflow and turn it into an outflow, you see the pressure will put on the dollar. A reasonable person might ask, well, if that's true, why did the dollar not go down from March to July? Very simple. Who was the biggest beneficiary of COVID? Obviously, the massive digital transformation companies, Google, Microsoft, not so massive, but Zoom, those kind of names. What country dominated in terms of those names? The United States of America. So the $500 billion outflow out of bonds was offset by a massive inflow from world central banks, from sovereign wealth funds into our equity market. By July, that had become pretty much in the market. The relative prices had gone up. And frankly, the vaccine profile was starting to look better. So that is when the dollar peaked, as that offset started to diminish. And as you know, Joe, the vaccine tends to cause a rotation out of growth stocks into value stocks. Our big advantage over here are the growth stocks. So that's why I think the pressure on the dollar is going to continue.
So in Druckenmiller's 40 years of managing money, every single time we've had a crisis, especially a global crisis, money has flowed into the United States. They've purchased dollars and they've purchased treasuries. But what happened during the cerveza sickness when the government came out with the CARES Act, this over-the-top trillions of dollars of deficit spending? Finally, the foreigners, like not the average Joe, but the average Joe's Chinese cousin, that's right, China Cho right here. China Cho started to give your drunk, insolvent Uncle Sam the finger. China Cho looked at the CARES Act and he said, I have had enough of the United States profligate spending. I'm not going to support this anymore. I don't want dollar-denominated assets. So the foreigners started to buy less treasuries. Since there's less dollar demand, we saw the DXY go down during this period. But Druckenmiller points out that what they started to do in lieu of buying treasuries, which is just a long-dated dollar, is they started to buy equities, growth stocks, which makes sense because if you're worried about inflation, you're going to have a better hedge with equities than you are with bonds. But notice that Druckenmiller emphasized they're buying growth stocks. So the Googles, the Facebook, the Zoom. But what happens, and he just briefly mentioned this at the end of the interview, what happens when interest rates start to go up, like we discussed in step number 2? We see a rotation, usually, from growth stocks into value stocks. And what's interesting is the foreigners, like China Cho, have many options outside of the United States to buy value stocks, but they don't have that many options to buy these high-flying growth stocks. We've got a lot of those right here in the United States. So what happens if interest rates go up? There's a rotation from growth to value, which means fewer dollars coming into the United States to buy assets, while at the same time, a lot more dollars are leaving the United States because our trade deficit is increasing because Moody, the average Joe, and the average Jane are producing a lot less stuff because the government is buying their vote with additional stimulus. And oh, by the way, the government will have to do exponentially more of, or else the whole house of cards will come crashing down. But again, I want to make it crystal clear that I'm just explaining Druckenmiller's thought process so you, the people watching this video at home right now, can make better financial decisions in the future. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.